be a useful time for us. So thank you so much for the invite, Derek, and I'm glad to see all the entrepreneurs here. Welcome to today's session. And as Derek has said, it's no, I think this is where we start on the numbers. I think we've been a little bit on theory for the last few sessions. So today we'll be more tackling the numbers. I hope we don't have those people who feel anything numbers, it's a nay. But I normally say as long as you're doing business, the bottom line is numbers. So after all is said and done, we still have to come back to looking at how the numbers are looking like. So I am hoping this is going to be helpful. So as Derek has said, I hope you've got like a pen, a paper, so that at least you can be participative. At least you can be able to look at some of the things that you can be able to do and see how you're going to finally translate into your own business. This is, I know, only just 2 hours, but I'm sure it's after this and after you get the note, it's something you can be able to apply in your own work. So welcome to today's session. Again, like we said, we're going to be dealing with personal finances versus business finances. How do you separate the two? We'll also be looking at the how to do a break-even analysis and working capital management. I know those are some of the ones that easily come into every entrepreneur's mouth in terms of when they're looking for money or they're looking for how they can get funding. Many people are looking for working capital, others are looking for loans. But I think bare minimum, everyone is just looking for funding in one or the other to meet some certain aspects of their business. So in looking at this, it's just a start point in terms of getting into the numbers, because going forward, we'll also be looking at more of the deeper aspects of the numbers, and I'm hoping that you can be able to translate this to your own, especially if you've been keeping your numbers and your records right. So I will not belabor much on that. Let me just share the screen. So I'm hoping you can be able to see my screen. Are you able to see the screen?
Yes, you can see.
Awesome. So yeah, so we are going to be looking at we are going to be looking at business and personal finances. We're going to be looking at working capital and break-even analysis. So I hope you're all ready for that. So maybe just for a start, and also a bit of now what we call the unit economics, that's going to be helping us on when you're dealing with the break-even analysis. Okay, so normally I know, like I was saying, in financial management, there are many entrepreneurs who are out there, but at times they are also very allergic, if I might say. Is it allergy or something like that to numbers? Because there are those of us who didn't like maths in school, and anytime maths was mentioned, many people felt like I wish they felt like any other subject but not calculations. But unfortunately, when you go into business, somehow you can't avoid it. So I am hoping this is going to be helping us a bit into looking into that, and that's why we call it, like, it's calm and silent, but it's the calm and silent waters that drown a man. In other words, there's a lot of deeper things within the numbers that we need to be able to look at. And as we're starting today into the next few Fridays, I'm sure, according to the program, is to try and unravel or just demystify the numbers, and looking at how we can use numbers to make decisions, how we can use numbers to be able to run the businesses efficiently, and even just do what is the right thing. At the end of the day, we are looking at the bottom line, which is the profit. So keeping financial personal versus business financials is the first thing we look at. And if you look, many a times what happens is, especially for small businesses, as we keep saying, at times it's very hard to separate your whatever you may call personal, whatever it is that we call business. Furthermore, most of us started business to be able to take care of our day-to-day activities and day-to-day aspects of our life. So when you're looking at your business, I don't know how easy it is to look at yourself as a business person and at the same time as yourself personally. And probably I can just engage a little bit just to hear if there is any kind of challenges that we face in terms of trying to keep our businesses different from keeping our businesses away from our own personal. So maybe I could just engage a few of us. Like I like saying, like, I think I kind of tend to, from my screen, I only see very few people, but I am hoping we can just have some little talk. Maybe I can ask Dr. Jeremy. Dr. How are you?
Fine. Hi, Mercy.
I'm very well. Nice to meet you here again.
Thanks.
Yeah,
Nice to
so
meet you too.
I know you run the clinic and all that. So I don't know, since you started, how easy or how hard has it been for you to separate your own personal finances from business, and what exactly does that mean to you?
I think for me, when I went through the TBN program, I think that's when I learned a lot, and from there I was able to separate. I think before I would, for us who use M-Pesa, would all the cash was coming to one line and use it for personal, use it for to pay your own personal bills, use it to pay business. So it was also even difficult to generate any accounts. But one of the things we've done is now everyone who works in the company, including myself, we are employees.
Mm-hmm.
So we get a salary, which is paid to my own personal account from the business.
Mm-hmm.
So I'm paid as a regular employee in the company.
Mm-hmm.
And that way, if I need to spend any money, I'm spending only what I have earned from what I've been paid by the company. So that
Ah,
has helped us to separate the business money from my own personal money.
okay.
And yes,
Oh, that's nice. So how did you determine how much you need to earn? And this is your business.
I think that was tough. Uh,
Uh-huh.
uh, so I think with the time, so what I did is uh, I looked at how much the business was generating,
Mm-hmm.
and I determined this is my value at this time. But depending on how the business is doing, I
Mm-hmm.
can only earn so much. So so that's what I started on,
Mm-hmm.
and yeah, so it's not easy. I can't say it's an easy thing. You always find sometimes you're going back and taking the business money for personal use, but we've tried to be more strict on that, and also
Mm-hmm.
putting in controls,
Okay.
making sure any money leaving is you're not the one authorizing payments and making the payments.
Okay.
So so internal controls are also helping to differentiate between personal and business.
Okay. Okay. Awesome.
Yeah.
Okay, thanks. So
Okay.
thanks for sharing that. The main challenge I hand is at times, yeah, it's your business and you need money, and yeah, so it can be a challenge. But thanks so much, Dr. for sharing that. Let's maybe hear from someone else.
Francis.
Okay, do you have someone trying to say something? Okay, probably I could ask. I can see someone, Sylvia Elianu. Hi, Sylvia. Do you have Sylvia there? Okay, can't get Sylvia. I'm looking for another name.
Kuna memory.
Sorry,
Ngoja niweke first. Kuna hiyo
is that Sylvia speaking?
As you know, it wasn't Sylvia. It was, I think, Evelyn. Evelyn, kindly mute.
Okay. Or would she want to say something? It's okay. If she would want to say something, it's fine. Evelyn? Okay. As you know, I like us being participative. So it's always good at least to hear. And maybe from Doreen Namatende. Doreen, are you there? I am hoping I'm not
yes, I
alone.
am, but
Great.
I'm traveling.
Oh,
I
you.
can't participate now.
Oh, okay. No
Yeah, but
worries.
yes. But anyway, what we do here, like Dr. like said,
Mm-hmm.
also have controls.
Mm-hmm.
So mixing personal money and business hard, but we put in some controls to help in here and there.
Okay. Okay, okay. Thank you, Doreen. I didn't get that you were on the road. Sorry about that, but it is well. So, let me just say, for as we start with this, the reason maybe some of us maybe in this session maybe we've been able to separate our personal finances from our business finances. Probably it's not been a hard thing, and probably there are those who have not even done it yet, and maybe there are those who still have challenges doing this. And so the main reason why we are looking at this today, and knowing that we are also looking at investor readiness at the end of the day, is to be able to keep businesses away from our own personal lives. It is not a very easy one, because like we said last time, many people when they're starting business, they are looking at how they can be able to meet their day-to-day needs. And maybe some people, they went into business probably from employment, and maybe from other kind of work, and so trying to maintain the same kind maybe of lifestyle that you used to have, or even just at least meet the bare minimum of the bills that you have to have like every other day of your life. So when you're doing business, or when most entrepreneurs get into the business space, a lot of times separating this becomes and it's not as easy. And it's the same place. I mean, you've been working the whole day, you're going home back home in the evening, so you need to be able to buy like some meat, to buy some groceries. And since you're coming from work, it's the main thing that most people do is that you'll get some maybe few shillings from your till and go buy whatever you need, and life continues like that. Now the main challenge is when that happens, like we normally say, it brings this kind of chaos, where money is coming in, going out, and we have no account of where the money is going. So it brings at times a lot of confusion, and many people stay on to the business wondering, I keep working hard every day, I do so much, but it seems that this business is not making it, or this business is not generating any money. And many people have ended up feeling like the business that they do doesn't generate enough to keep it afloat. And what happens is, because we've not been able to know how much are we taking away from the business, because you're using the business to cater for all our personal needs, and in the process we don't know what exactly is being generated in the business. So being able to separate these finances in terms of what is business, what is personal, now becomes very critical. Even when you're getting to talk to the other people who can invest in your business, whether suppliers, even funders and all that, they need to be able to see what exactly is the business doing. So when there's everything mumbled up, it becomes very difficult. So what you're looking at is to be able to have the same person, like the way we have this lady here. She's the same person on this side, she's business, on this side she is personal, and it's the same person, yet you can be able to separate. You can be able to know when it is your business side, when it is your personal side. And so at the end of the day, we'll be able to see how we can be able to do it, and some of the actions we can be able to take. Doreen and Dr. Jeremy have given us just a few of them, but we'll be able to be looking at some of the things that we can be able to do to separate our finances from the business, and what is, so that you can be able to have business, and we can be able to have the normal running of the business effectively. So sorry. Yeah, so some of the things that then we can do, like what Daktari have been able to share, is how can we then be able to keep that? So the first thing that we normally say is being able to keep business records. Why we need to do that is we need to be able to determine what exactly is happening in the business. And I don't know, maybe from all of us, I don't know how easy is it to keep business records. I don't know how hard or how easy, when you've been needing to maybe produce those records, how easy has it been for you to manage to retrieve those documents, and how accurate are they? I don't know what's your experience in the business. For those of us who are already, I mean, for all of us, because I'm sure you've been doing this for a while. Um, So maybe it's something else that maybe I can also just want to hear from us, because this is actually the foundation of what you're going to be doing as far as numbers are concerned, whether today and in the subsequent days that are coming. When you're looking at the numbers, business records is key. But I know a lot of times most businesses don't keep records, or they just keep a bare minimum. They just write, I don't know what you do. Let me just hear what's happening as far as business records are concerned in the business. Um, Simeon Masai, are you there today? How are you?
Hello, I'm
Hi.
fine, thank you.
I'm happy to see you here again.
Happy to see you too.
Hey, so tell me, business records for you, do you keep them? And which ones are you keeping? How effective are they when you've needed them and all that?
So for me, I have a book to record. When I stock the business, I record what I've received, and then it helps me also to do pricing. And also when I sell, there is a book also for recording the sales
Okay.
and purchase records. And then it also helped me to calculate the profit margins per month and make some decisions. So yes, I keep records very religiously.
Okay, that's nice to hear. At least that you keep records. So the main ones that I've had is the sales record, and that also helps you to keep to finally be able to determine what is your profits. Did I get it right?
Yes.
Okay, all right. So,
And also it also help me to know the fast moving product.
oh, it also helps you to know. I know you're the one who was selling gas, if I may remember.
Yes, gas and electronics. Yeah.
Okay, gas and electronics. All right, yeah, that's great. So, do you have any? I know you've said you religiously keep your books and all that, but have you had any challenges? Are there times you've missed out on records and all that?
Yes, there is a time that I left someone to look after the shop, and so for a few days, and then I came. There were no records written, so it was a very big challenge to know what happened during that time. Yes.
Okay, so as long as you're there, it is done well. When you're not there, you're not so sure.
Yes.
Okay. I'm not so sure that you've done business systems or systems and processes in the past. I'm not so sure that you've done that session yet, but yeah, that calls definitely for where you work around your systems and processes, so that even when you're not there, business is able to run as if you're not there. But anyway, the main thing, as you're saying, is when you're looking at your records and what is happening in your business, it's important to have records, because those are the ones that will be able to help you. And even as you're going to do a few of calculations, they're going to be quite simplified. However, with your records now, you're able to do it, because it doesn't matter whether you're doing with simple numbers or big numbers, the formulas remain the same. That's the beauty of maths. For those who don't love maths, that's the beauty of numbers, because the same formulas will apply whether for small numbers or whether they're applying them for big numbers. The difference is the same. So, but the whole idea is when you're looking at being able to separate these two, you're looking at also being able to ease your tax matters, because again, even when it comes to tax issues, in whichever country you're in, they will be able to require that you do both business taxes and personal taxes. So if you're able to separate these two, then also taxing becomes easier, because the way taxing is done for personal finance or for personal money is not the same for business. So it's important to be able to do that, so that you can also, even the tax issues can also be they can also be aligned, so that you don't maybe suffer unnecessarily paying unnecessary taxes because you've not been able to put things to well. And even just your profile, like I said, many investors are trying to understand not your personal life, but mostly your business life. So when you have both of it tampered, I mean, it's all jumbled together into one, then also investors have a hard time being able to determine what exactly is the business doing, how is it doing. Even if they were to come and be a part of the business, what exactly does this business look like? So being able to separate that also helps them, and it's very key, especially as you're doing this program, which helps you in terms of being able to get to that space where investors can be able to come in and participate in your business. So it's really very key. And probably this is a question at this point in time, just a reflection for us to ask all of us. How, where do you need to do that separation of personal affairs from your business matters? In what ways do you need to put your business away from yourself? And this, you look at it from both in financial matters, that is not just money, but also in terms of other non-financial matters. Many times when you look at separating business from the individual running the business, we think about just the money, but there are also other non-financial areas that you need to be able to look into. And so I don't know, just think about it, and even maybe in the chat you can be able to maybe share, where do you think you should be able to look into that, other than even just thinking financially? What are the things that you need to do to be able to separate your finances from your own personal business? And so maybe I'm just going to point a few, because I want us to go to the calculations a little earlier so that we are not short of time. But just as you're thinking through it, there are some of the things you can think about is um, the legal entity of your firm. If you remember when we were doing the business DNA, I think it was the second or the third session when we were doing the business DNA. I think one of the things that we talked about is how to be able to set up the company, or to be able to set up the business such that it's able to operate on its own. You give it an identity. Part of that is being able to separate now, to, or rather to come up with what kind of a business are you running? Is what legal entity is it? Is it a sole proprietorship? Even if it's a sole proprietorship, there's still a business name that accompanies it, so that you can still be able to separate things that are running on the business from your own personal. And best still is when you get it to coming to being a limited company. And I'm not so sure what the other countries everywhere could be calling that, but being able to have a limited company that is distinct with its own shareholders. So you could be a shareholder. Definitely, yes, you will be a shareholder. But the legal matters, when it comes to legal matters, it is able to, when you have it as a company, it's differentiated as its own entity. Like if it were two people, so you and the company are like, east and west, you're not the same. So the company can be able to handle its own thing. So it's very important to be able to do that. And it's one of the first steps of being able to do that. And that way, because you'll be able to get your own licenses, the business will be able to get its own licenses and its own permits. And so it doesn't have to be able to run, it won't be able to run like every, like as if you're one. So, and the other thing is, now once you do that, you're able now to open even like a current account or bank accounts in the name of the business. That way you start separating now business from your own personal finances. I know many times when people are starting, I mean, you have one account, and at times I know also banks are also a bit stringent in terms of the things they're looking for. And I know, I don't know whether it's everywhere, but I know here in Kenya, at times when we talk about being able to register companies and being able to open accounts in the names of the business, many people have issues around tax, and they're feeling like maybe they're exposing themselves to tax to the taxman when they do that. But again, it's because I know we are not dealing with the legal matters. I'm hoping either you've done it or that would come somewhere along the way. It really does help a lot, because when you have a company and it's dealing on its own, in its own, being able to even take its own liabilities and being able to take care of its own business holistically, you really get yourself out of the many issues that can come. Like, for example, if you've borrowed some money and you're not able to pay, as a business, if you have a business running on its own as a separate legal entity, no one will be able to touch your own personal car. Nobody will touch your bank account. But if you're running it as, jumbled up, it's still your personal, it's you and the business are one and the same thing. Even your clothes can be sold when you're not able to pay for it. So it's important to look at this. And just to reiterate, in as much as I'm not in the legal fraternity, at least the one thing I know is, for the court to be able to come to you as a person, they first ensure that they exhausted every avenue of working, or rather dealing with the company, before they can do what they call unveiling the company. And it's only until the court gives an order, which also takes time. A lot of things happen before they unveil. So until when they unveil, and now they can be able to come back to who is behind this company, to be able now to start touching you as a person. So that really makes really work so much easier for you. So think about having your a bank account that is separate from your personal, including those who are dealing with credit cards, M-Pesa like here in Kenya, or any mobile money. Just have one for yourself and have one for the company. That way you're able to start separating, and so that now whatever is needed, you strictly bring it to the, ensure that if it's business, it is business money. If it is personal, it is personal money. So you have your own personal accounts away from the bank accounts. And I also like what Dr. Jeremy talked about, also the salaries remuneration, where you pay yourselves as the director. Okay, now if you're more than one shareholder in the business or come directors, for most of the small businesses, the shareholders and directors are generally the same. As you grow your business, you're likely to find even maybe you will separate that also. But let's just think of it from the small business perspective. Most shareholders are also active directors in their company. So the thing is, being able to determine your own salary, how much are you going to pay yourself? So there are many ways you can do that. You can bring in someone to value your business. You can bring in experts who can be able to see how much your business is making, or you yourself can determine how much you can pay yourself. But I think one of the things I like saying, for simplicity, if you've not if you've not started paying yourself, because this is where we find most people, most times, uh, entrepreneurs don't really like pay themselves per se. They just pick small monies from the till and do things that they want to do. So what you can do, if you've not started doing that, just make sure you're having good records, record how much you're using for personal things, whether you're going to buy someone a soda when they visit you, you're going to buy some lunch for yourself, you're going to pay school fees, you're paying rent, school fees for your children, you're paying rent for your own house, maybe where you live from the business. Just don't be so hard on yourself. I know at times when we say this, it feels like you maybe doing it really so wrong, but I think what I would want to encourage is just look at it from how much are you using. So note what you're using every other day, so that you can know at the end of the day you'll have used so much. So once now you know how much you use maybe per month, then now you can start being able to determine, this is the amount of money that I need to pay myself. So you may find maybe every end month, by end of the month, you use between 40,000, 50,000, or even 70,000, whatever it is as per your needs. First and foremost, it's to mean that your business is able to cater for that. If you're able to pay the rent, the electricity for the business, the salaries for your staff, and you still being able to do your own personal things, and so that means you take some money away from the business and it still survives. So you can determine around how much you can be able to pay yourself. So if you've been getting about 40, 50,000, 100,000, you can determine now how much you can pay yourself as a director of the company. And over time, then you can be increasing your remuneration just the same way you increase for your staff as the company does better and you continue doing well. And maybe just to reiterate also here, I know maybe as you're saying salaries and all that, maybe just a mention. I always encourage that even though you pay for yourself and you have a salary, please don't pay yourself fast. Means when we say yourself fast, it means pay as you're paying the other employees, but please always try and pay your employees before you pay yourself. That's a very personal thing, because I've seen in many businesses, even especially when you're doing coaching, and part of the issues at times come when your employees are not paid. But you yourself as a director, maybe you're still paying yourself, you're fueling your own car, you're doing your own entertainment, yet your people as are not yet paid 1, 2, 3 months. So that also does affect your business. In as much as you're not looking at processes and all that kind of thing, it's something just which is a good to do. But nevertheless, pay yourself again, because you need to pay yourself as you pay the other people who are working for you. So become a part of the employees, pay yourself as you pay the others. If you haven't paid your employees, also don't pay yourself. That's just me thinking aloud at times. It's important. Then looking at it, some of the internal controls, even like things like when you're signing contracts, make sure you're entering into contracts as a business. So if you have a business name, if you have a limited company, make sure that those when you're putting in the signature, you're putting in a signature like a director, not the owner of the business. So where you're able to separate those things. So sign everything up, the letterheads in your, the paperwork or in the company's name. It will really help you a lot. and like we said, even the first time we had the class on business the business identity, have everything well done from your strategic plan, from all documentation well put together for the company. And by the way, just to reiterate, as part of as we were dealing with a strategic plan, I think one of the days we did that, this is what investors will be looking for. They want to know, what's the company all about? Where are you going? It's these visionings that you have in your mind. It cannot continue being Mercy's plan, Mercy's vision for where we are going. Make sure you translate and put that in the business name or in the business company, so that when the investors come in, they're able to see the business as a completely separate thing, including where it is going and the things that you want to do, even including, separating your personal hours. What time will the business open? What will it close? So if you open maybe 8 to 6, that's business hours. Then you need also to be able to separate your, even your timing itself, so that when it is up to 8, it was personal time. Then after 6, now you're lending extra time to the business if you have to be in the business. When you start doing such things, you'll actually even start finding that the things that you're doing and how you're doing business is starting to feel different. You don't feel like you're part and parcel of it. And that also starts helping you now to also develop and the employee the team that you're working with, the employees that you need to bring in, what roles they need to do, so that you can also start now separating yourself as a person from the business. And I'm hoping you did that when you're doing organizational structure and human resource, just to be able to give other people, you delegate some of your roles to other people. That way you start now separating yourself also from the business in terms of being able to run the business. And I think, like Simon has just said, like when he was away, the records were not being properly done. Yes, when you're bringing in other people now, systems need to be in place to be able to ensure that things are being run the same way they would have run if you're there. So as you do these kind of things, you're able to allow also people to be able to see business as a separate thing. In fact, where this works very well, even employees are not able to tell that you're the owner. You're working, but yes, they know you're the owner, but it doesn't really click like this has to be done this way. Some of the things you're not the one who authorizes. Sorry, you let other people, do those kind of things, including like what you're talking about, signatories. So I hope you can be able to see some of these things. I don't know whether you have any question in terms of that before I leave personal finances. Any question? Is there any one of us who works in the same business where you pay rent for where you sleep and where you work is one and the same thing? all our businesses have gone way beyond that, eh? I hope so. Okay, let me ask maybe someone before I leave that. Charity, I don't know if I've ever met you, but I'm just hoping, I know it's maybe it could be a share of name, but Charity, you can maybe just share with us a little bit. When, for example, your business has had some failures, or maybe things didn't work out well, and maybe you have an order to, to fulfill and it didn't happen. How did you handle that? Maybe, Charity, are you there?
Yes, I'm here. Come again with the question.
Yeah, I was saying I'm not so sure that I know you or it's just a name. But I was saying, when maybe you're working on your business and say probably things haven't worked, maybe you have an order to fulfill and it didn't work. How did you handle that when things didn't work for you as a person now when you're dealing with your own business? How did you take it?
Well, there are many instances where things don't go according to plan.
Mm-hmm.
But, well, do I have a specific scenario? If it's something to do with an order and maybe we are struggling to deliver, for example, first of all, it's good to prevent. You try as much as possible to prevent for some of those things from happening, meaning that you have to do proper planning. Though, even when you plan, some things don't work according to plan. One of the most important things that I find that is super critical is to communicate. Communicate to your customers, communicate also internally, and try to brainstorm, with the rest of the team and see what what could work. But if things are seemingly, for example, an order is not going to be possible to deliver within a certain period as agreed in the contract, you communicate beforehand, tell the customer that these are the possible solutions and see whether they accept.
Okay.
For us, most important is to make sure you communicate and
Okay.
don't wait until this last minute.
Okay.
Communicate beforehand, which means you're anticipating some of these things. We
Okay.
deal with an agricultural product, and some things you can't predict. You may not predict the quality, you may not predict the quantities that you're able to get. So being very hands-on, know exactly what is happening almost on a daily basis, but make sure to communicate.
Thank you. Thank you so much. And actually, it's like we always say, it's all of us learning from one another. So I think what the main aspect you brought there is about communication, which is really very key. And communicate as a business, not as a person, as at your personal level. You communicate as a business because it's the business that is having issues, though it is because you're just a part of the employees. But the whole idea, even also again, is at times when you've had failures in business, at times it becomes very hard to realize that it's a business and not you as a person. And what has happened is, I know, like one time I was dealing with a client who the business was really having a hard time, and in that they also felt they were not good enough in terms of they as a person. So even when it comes to your emotions, when you start seeing business in its own entirety as a business away from you, you're able also to handle your emotions, where you can be able to see that even when the business has failed, it's you, business systems, the employees, the customers, the suppliers, but not you as a person, so that you're able to even be able to put yourself together and do things differently without having to put yourself together with that. So I don't want to over-indulge on this a lot because I want us to just go into the numbers, but I hope this helps a lot, at least here and there. And maybe one other thing I may want to, whatever, to talk about, if you haven't handled it a lot, also is being able to create a succession plan. If you were not there, who would be able to be running business in your absence? That's something very key. Most small businesses, I think most of the times they don't even get there, but it's important to start thinking about that so that you can start thinking, in the event that I was not here, or maybe I am sick, or I have traveled, or whatever, can the business be able to run on its own? Then that way you can be able to see how you can separate the business issues, so that those who come and take over, they also don't get jumbled up with your own personal things. Some businesses, you see some owners where maybe they even have employees, but the employees also take their children to school, they drop them on their behalf, they take, I don't know what vehicle to do, those kind of things. So being able to separate things that are personal from your own business then also helps you in terms of even the people who are coming in for succession planning. They can be able to understand this is business and it has nothing personal as far as running this business is concerned. And that way then you can even be able to transfer in the event that you may want to then to sell. It makes it easier, including managing any risk that may come. It's purely the business that takes account of it and responsibility. So that way it makes it just easier to run business. Okay, so I want us to go into the unit economics. If there is no question, anything, I want to hope. Okay, I just want to see anything on the charts. One key challenge is maintaining a clear boundary between business income and personal expenses, especially when you have to explain to your spouse that there is no cash for household needs, even though they have seen you receive business payments from clients. Thank you so much, Dr. Jeremy, for saying that. Yes, I can imagine. And also, like we've been saying, most small businesses are family owned in terms of maybe the husband and wife, or even at times the children get involved in the business. And yes, people are seeing money coming in, money coming out. And as you're going to be doing in the next few classes, when just to determine whether even you're making money, many people don't understand that receiving money, and you're selling your whatever you're selling, your goods or services, and money is coming in. Most people think that there's money to be used, and in fact when you start saying there's no money to do this, you're seen like you're either very mean or someone who doesn't want to spend. You spend on yourself, and so this becomes such a big problem. And where possible, it's also good to, that's why when you start keeping records, you can start also just like small education to the other parties, for them to be able to see. And by this, not even spouses. I don't know that you struggle with employees who see money coming in the millions, especially the very cash intensive businesses where there's a lot of money passing in and out. So there's a lot of money we collect, maybe even like almost 1 million every day. But most people don't understand that this is a very cash intensive business. And so for they cannot understand why you have to be paying them 30,000, assuming, I don't know whether you pay that kind of money, 30,000 now, and I'm talking in Kenya shillings. I don't know what it translates in the other countries, but maybe you're paying someone 30,000 and they're thinking, this is very small money. I labor here every day. We collect so much money, and this guy doesn't even want to pay us. So many people don't understand that what pays is not really the revenue, but it's the profits. And so this is where some of the conflicts start coming in, even with your employees. So it's something good to keep your records well when you're going to be doing your profit and loss account, to be able to share that also with your employees and to be able to share with your spouses. One time I was doing a mentorship sessions with one client, and he told me clearly, I cannot keep these records. And the reason being, the moment the wife is able to see this, it's going to be it's going to be very hard for her to be able to see that maybe in a month we collect so much. That's going to be so much headache. So you'd rather not do that. And so I can imagine some of the challenges that come in with maintaining records, maintaining the numbers, because you want to keep the peace with your family, with your employees. Sometimes you don't want your employees to see how much you do, how much you make, overall, how much you make, and so becomes a big challenge. So I don't know how those who are handling it, how you're handling that, in terms of communicating that this is how much you're making. I can't be able to do this because this is the match that the business has. I don't know that that's a challenge to many of us, or it's just Jeremy who goes through that. So maybe if there is no other question, I know that's a challenge that maybe we could even talk about for quite a while. But if you need to share anything around that, please feel free to unmute yourself, and then we can be able to share around that.
I think I agree with Jeremy, where sometimes the business looks like it's doing better than us financially, or sometimes you have to actually put in money into the business. A case in point, for example, you're struggling to make expense to make, for example, maybe payroll. So you find as a director, yes, you want to pay, you say you want to pay yourself first, you have put yourself on salary.
Yeah.
But then you look and you see you have to pay the suppliers. And so you decide, okay, fine, let me wait. Let me not earn a salary this month. Let me wait. Then when the cash flow improves, I will earn my salary. So your salary remains there as the business owing you. And you find that it is going, time seems to be extending. If you decide that you're going to pay yourself first, then you'll have to frustrate some of your suppliers. When you don't pay your suppliers, then you don't have staff to be able to continue running your business. So sometimes that thin line for small businesses is a challenge. And then especially when you're expecting money from places that are really not within your control. Like for example, if you're waiting for money from government. So for us who are in healthcare, you're waiting for money from the government health insurance. If they delay in paying the hospitals, they delay in paying you, then your suppliers can't give you your supplies. So you find that you yourself as a person ends up taking a hit so as to cushion the business. So those are some of the challenges us SMEs face.
Yeah, sure. I totally agree. In fact, that's what I was saying. The good thing is, at least you've determined a salary that you should be paying yourself. So anytime you don't pay yourself, is see it as a loan to the company, and the company needs to pay you at some certain time. So your records need to be shown clearly that yes, you've not been able to pay yourself because you've paid everyone else. Because if business has to continue and you're the one who is paying yourself first, I know we normally say pay yourself first. Pay yourself first means be part of the employees, so that when you're also paying the others, then you pay yourself. But I think normally it doesn't reflect so well for you to pay yourself, but your suppliers are still having issues. Remember, in due time they'll stop selling to you, If you're not paying your employees also in due time, they'll stop giving the services, or the quality of service and productivity goes down, so you suffer more. So it's a thing to just also think through and see how do you do that. And a lot of discipline is also required. Even in as much as you're doing this, you need to be able to discipline yourself so much, not necessarily to pick more than it's required just because you're seeing it, but being able to stay within what is required. So when you plan for the things that need to be done, including your salary, should you not pay yourself in time, even when you've not paid your suppliers, they're actually loaning you. When you're not paying yourself, you're loaning the business. When you've not paid your employees, you're loaning the business, because at one time you need to be able to pay them. At one time you need also to pay yourself. At one time you need to clear your debts with your supplier. So every time you see you're not paying, make it a point to see that this is loaning to the business. But then you need also to have a proper perspective of how you do the financial management, so that you also don't keep these owings for far too long, because they can also end up being very expensive for you. Like, for example, you don't pay a supplier in time, you can imagine they can go to court. If they go to court, then you know what that means. You may end up paying so and so much than you could have paid them. So it's just about being able to keep your records clean. And that's why you remember I was asking, what challenges do you have in terms of keeping records, ensuring that they are within the mandate of what is required, because otherwise then you're going to have a hard problem dealing with your business when you cannot be able to account for what is going where, how much is going where, what needs to be paid when. So prioritizing all that and making payments is very key in terms of being able to run the business. So thanks so much, Dr. Specky, also for sharing that. It is indeed an issue, and especially when it is being family owned, it becomes even a bigger issue, because family also gets involved in it. At times they don't understand, and when they are not very active, they may feel like maybe you're not actually being cooperative as far as family matters are concerned, and yet you're doing business. Yeah, so it's tricky, but the moment you start separating things, you'll be able to even account for it, be able to show what is coming in, how it is being used, and so people can start seeing how the business is doing, rather than just having to blame you for not doing the right things as far as family and personal matters are concerned. Okay, thank you so much for that sharing. Now let's go to we were dealing with about 3 things today, so we're also going to be looking at unit of economics, so we get into the numbers a little bit. And the whole idea of unit of economics, what you're looking at is, now as you're looking at your business, at what point are you able to say that your business is really making money? So it is important to know what are the units that you're dealing with that generate you the finances or the revenue for your company. So if, for example, you're like now the ones who are doctors here, your unit of economy would be now the patient. So because you'll be asking yourself, how many patients do I need to see, or how many patients are we seeing on day-to-day basis? If you're maybe if, for example, it's a butchery or something, you're looking at a kilo of meat per, every kilo of meat that you sell. So your unit of economics is what you're dealing with. For us who are dealing with services, like myself being a trainer, one of the things that I'm looking at is how many people am I training. So the trainees are my unit of economics. So you're looking at what is it that you deal, what is that gives you money. So that which brings you the revenue for your business is because you sell it at a price. And so when you sell it, that's what gives you revenue. But for you to sell, it also costs you something to be able to get it. So that which you get now is what is the cost of doing the business. So you need to be able to determine what is that which you sell, how much do you sell it, and how much does it take you to sell. If you remember the day we were dealing with BMC, at the bottom line, now that is where you're dealing with, you're looking at now the costs versus the revenue. So you're starting to balance out revenue versus the cost of running the business. And so while you're looking at now, once you determine what are the things what is that exactly you're selling, and what is that which gives you the money into the business, then you're able to start now making decisions based on that. And so today we are going to be using the unit of economics more to help us to determine when do we start making money, how do we determine that now the business is making sufficient, or it's making something, or how far off are we from making what would have required us to do. Now, remember, in your strategic plan, part of what you should have done is where you project your cash flows, you project your revenues and including your cash flows. How much are you going to be making? How do you want to make it? So I think that we'll be doing it in the subsequent sessions. So, but while you're doing that, then this unit of economics, when you start looking at what you're making it out, they're going to be helping you, is to help you be able to determine, like, even what pricing, what cost are you getting into, at what point will you be able to be making money, and how much do you need to sell to do that, how much can you forecast into the future, how much profits can you be able to make. And so we are going to be looking at this is just what I was just giving some of the examples. So for us to be able to determine that, we need to be able to know what revenue are we making, what cost are we making. So you see, we go back again to being able to maintain proper records so that we can be able to determine how much are we using to make money, how much is money being used to make money. We normally say money generates its own money, so you need to be able to spend money to make money. So how much are you spending to make money? And that's why it's very important, as you're looking at now your unit of economic, what is it that you're doing, how much is it costing you to bring that item or that service into the business, and when you bring it, how much are you getting out of it, how much revenue are you making, and what is it costing you. So cost becomes also very key, because then you're looking at both what we call fixed cost and variable cost, or what we call direct cost and indirect cost. What this means is, when you're looking at, for example, now let me give an example. Like, now let's say you're doing, I think last time I did an example for bakery. So when you're doing a bakery and you're producing bread, so for you to produce bread, you need to do, the baking and everything. So every time you're baking, you have to buy flour, you have to buy the oils, you have to get people to do the work. So there is things that need to be done. You have to buy those raw materials and then take them through the process so that you can finally get bread. So that process is it's not constant. In other ones, is to say that for you to be able to produce bread, if you want to do like 1,000 units, you just need to buy flour of this up to this level. You need to buy this number of kgs. If you need to do 10,000, then you have to increase that. So that becomes what we call the variable cost. And then fixed cost are these costs which will always be the same. You'll incur them whether you do any production or not, whether you sell anything or not, you still have to pay for it. And examples is, for example, if you're paying like rent. If you're paying rent, it doesn't matter whether you produce 3 pieces of bread or you're doing 10,000, that rent will be paid. So if you've been paying, say, rent of 30,000, 50,000, you still have to pay it whether there's production or not. And all the other salaries, advertising, electricity, all those will remain fixed costs. So the whole idea of when we're looking at this is, as we're getting to this, is to be able to determine at what points do we start making a profit. And that's what we call, in this space of finance, we call it the break-even point, and even the break-even amount that you need to be able to know now you've been able to take care of the expenses that are incurred for you to get revenue or to do business. So once you're able to get that, then it helps you a lot in terms of being able to generate your business. So some of this, I know we could have done an exercise, but I know when it is online, it's not very easy. But you can imagine something like, maybe you can just, you can even put on charts, like if you're doing marketing, how much is that a fixed cost? Is that, okay, sorry, I was looking at something from the charts. It's okay. I think Natasha has dealt with that. So if you're thinking like marketing, for example, marketing will be a fixed cost, but it doesn't matter how much you spend to advertise, for example, on radio. It doesn't matter how much you put on bill. That is a cost. It is not determined by how much you're going to sell. So that remains a fixed cost. If it is raw materials, definitely that will say it is a cost to, it's a variable cost, because you'll buy raw materials based on production levels that you have. If it is salaries, that one is fixed, because whether you make money or not, you have to pay salaries to your people. If it is fuel, something like fuel, that one is a variable, because you don't need so much fuel if you're not producing so much. So the more you produce, the more fuel you need. Depreciation of assets will remain constant, so that's a fixed. Office supplies also likely to remain fixed cost, insurances and all that. So maybe just to reiterate is fixed costs remain fixed for a up to a certain level. So when you're dealing with your business, there's at one time that you know I'm paying rent of this much, so it remains fixed. But when business becomes so much and you have to maybe open another, maybe place another location, and maybe you have to do maybe increased marketing, or you have to employ more people, so then that fixed cost which was there maybe last month may not remain the same this month, but generally fixed cost will remain the same in a longer period of time. It's not something that changes every now and then. However, I'm just trying to say they start looking like a variable cost when you need to increase on it so that business can be able to proceed, and mostly when you're expanding, when the business becomes bigger. But in a constant situation, anything that you're paying, whether you make a sale or not, will remain a fixed cost, and anything that you need to purchase for you to do production or for you to be able to sell, that will always remain a variable cost. So I hope you are able to get that, so that when you're doing your calculations, you can be able to get that. And so we want to get to what you're now calling the break even and why we need it. And as you can see in this, as you can see, break even is where you're making at that point where you're not making any loss, you're not making any profit. It is in a scale, it balances. It's like when you're doing one, like when you're buying, say for example, you're buying sugar 1 kg, and you have that scale that is used to measure, and so somebody puts 1 kg measure on this side, and then the sugar, now they start putting until it balances. That's balancing, when it is even in terms of it's not dropping on either side, it just stays on a straight line, is what we're calling break even. So even in the business, you need to be able to determine at what point are you not making any profit, and at the same time you're not making any losses. In layman's language is at times what we call that level when in the business, when it's able to take care of all its expenses and you don't have to go back to your pocket. In other words, you don't have to go back to your personal finances to be able to finance the business. That's what we call a break-even point. And so when you're looking at that, I hope you carried your pens and paper and calculator. You can use your phone, but so that you can be able to just look at some of these things, and maybe just do some 1 or 2 examples just for you to see how that is done. So when you're looking at costs, what it costs you to do business, like you're saying, it will cost you variable. Those are the costs that are changing now and then, and the ones which are fixed. So if you've made some certain sales, which is now the total revenue you've made in the business, and you make those less costs, whatever it is that you've incurred in terms of variable cost and fixed cost, then you make a profit. So at the break even, it's where these sales that you've made, including these two costs, variable and fixed costs, the profit is zero. So when the profit is zero, that's now when you can be able to know you're making a profit. So you're at that break even. You're that either side, you can go into either loss or profit, but at least now you're balancing. So this is what we call the break even. And why it is so key, because you need to be able to determine at what point do you start making any profits. So to be able to do that is what I want to give us just an idea of, if you're doing a calculation, how can you be able to get that? So you look at your sales, total sales, and then we first calculate what we call a contribution margin. So I know this is just for purposes of teaching. Don't worry about the big ones at times, but just get the concept. So once you have your sales, the total revenue you've made, and then you less the variable, those costs which keep changing, like I was saying, like in a bakery, the cost of buying the flour, the cost of buying the oil, the cost of doing the fuel that runs the machine, those are variable costs. So if you get whatever sales less those variable costs, is what we call a contribution margin. In other words, if you're looking at maybe your profit and loss, is what would be coming in as in the space of gross margin. But again, I don't want to go into bigger ones for those who are not doing your accounts, because I don't know at what level everyone is. So let me just use the simplicity of it. But when you're dealing with the financial statements, maybe in the next few weeks, you're going to be seeing this coming back again. So for you to get that contribution now margin per unit, if say for example you were selling bread, so unfortunately I don't have an example, but I just want you to imagine, like for example, if you're selling bread and you're selling it for say 70 shillings and you bought that bread for 50 shillings, so your contribution margin now for that bread that you normally sell, assuming this is a shop, you'll need to use what selling price do you have plus what is the variable cost for that. So variable cost is the cost that you use to buy the piece of bread, and the selling is what you're selling at. So someone can give me even in the chat, or someone can just give me an answer. If you are selling bread and you're selling it for 70 shillings and you bought it at 50 shillings, what would be your contribution margin for that bread using this formula? Anyone? So I can see if we are getting somewhere together. You're buying bread and you buy bread at 50 shillings. Maybe I can talk to Zosiwe. Zosiwe, are you there? I heard you say you're in
Yes,
SA.
I was.
Great. I heard you say you're in South Africa.
Yes.
All
So
right.
I'll probably use this.
Okay, tell me, what answer would we get? You're selling bread at 70 shillings, you bought it at 50 shillings. What is your margin for that using this formula here?
If I'm selling at 70 shillings.
Yes, and you're buying it at
I bought it
50.
at 50, then I'm making 20.
Great, thank you. Now, I hope all of us followed what Zoziwe has just shared. So if you're buying bread at 70, selling it at, you're buying at 50, selling at 70, you are making a contribution margin of that bread at 20. So I hope for whatever business that you're doing, think about it in that perspective. Like Simon, I know you normally sell gas. So per each cylinder, how much did you buy? Per each cylinder, how much are you selling? That's the contribution margin. So I hope all of us, I hope I don't leave anyone behind. So then now let's look at how you can be able to get now that point where you're actually making a margin or not. So the formula again, this will be shared with you, but just so that you can put that again. So Ziwe, let me come back to you. So you are buying bread, and I hope you're all following. So Ziwe, I'll come back to you. So let's assume you have a shop that you're paying rent maybe 10,000, you're paying, or 7,000, you're paying maybe your staff, you're paying, what else? You're doing some kind of marketing. In total, you're using about, say, what do I give? 15,000. So you're giving like 15, you're paying, no, or let me give 20,000 so that it makes it easier. So let's say all your cost of paying rent, paying salaries, those are the fixed costs. Remember we said fixed costs don't change constantly. In over time they remain the same. Whether you're making any money, whether you're selling, whether you're doing production, you still have to pay. So you guys have to pay for power, you have to pay salaries to your staff, you have to pay rent and all that. So those are fixed costs. So Ziwe, coming back to you, and everyone else can be trying to do the same. If your total cost of doing your fixed cost is something like 20,000, I'm using very small amounts so that we don't have had issues here with numbers. So it's just 20,000, or maybe let me put it 200,000 so that we can include everything. It makes more sense. If you're doing 200,000, please calculate for me your break even using this formula. Remember, for the same bread, which your contribution margin was 20. So Ziwe, are you with me?
Can you repeat that again?
I'm saying, assuming your total fixed costs, that you're paying rent, you're paying salaries, you're paying electricity, you're paying marketing, all those things which over time they remain the same fixed cost. So let's assume that if you're doing your proper recons and you keep them nicely, you realize you do about like per month you spend like 200,000 on fixed costs. And remember, you're still doing bread, which you were selling at 70 shillings and you bought it for 50. So remember, you already gave us a contribution margin coming from the previous. Remember, we were here.
Yeah, which is 20 shillings.
Exactly.
That's your contribution.
Thank you. So now I want you to give me the break-even point using now 200, which is your fixed cost, 200,000 divided by 20. Every one of us can try and do it as Oziwe gives us the answer.
Okay.
You can also be writing on chat for the rest of us as a... Yeah, Simon, I got you got that. Any one of us? So what the answer did you get? So Siwe, what answer? I hope you carried a calculator. 200,000 divided by 20.
That's 10,000.
Thank you. Did everyone get 10,000? Hopefully, because this being an online class, I know I may not be able to get to engage all of us, but I hope you all are able to get 10,000. So if you get 10,000, what that means is that you need to sell 10,000 pieces of bread for you not to go back to your pockets, going back to the layman's language. In other words, I hope everyone has gotten 10,000, and so now we can translate that back to this formula that we had here. You remember this sales less, no, not this one, sales to get a profit. So I want you to use, remember, all of you. So you remember you are now selling, the calculation tells us we need to do 10,000 pieces of bread for us to get to a break even. So we said our selling price is 70. So you can do, for you to get the total sales for 10,000 pieces of bread, what would that be? If you're selling bread at 70 shillings and you're selling 10,000 pieces, how much will that be?
You're selling?
You're selling bread.
70 shillings.
Yes, you're
10,
selling.
000.
Yes. Anybody else? You can also be so ideally you're doing 10,000 pieces of bread, because that's what we've gotten as the break even, times 70 shillings. That is your selling price. So we are looking at the sales that you'll get for 10,000. So how much in total will you make?
I think 700,000.
Thank you. So I am hoping everybody has been able to get 700,000. I am hoping, yeah, thank you, Jojo. Yes, yeah, thank you, Jojo. Bakimi, you've also gotten it. It's 700,000. So please let's go together step by step so that we can all see how this break-even comes in. Okay. Now, sales, we've gotten 700,000. So I hope everyone is there. Now let's do less costs. It means we bought bread at 50 shillings. If you remember, we were buying 50 shillings per piece of bread. And we said our break even is when we sell 10,000 pieces. So you can now do the first costs of doing business is the variable cost. This is the cost of buying the bread itself. So do 10,000 times 50. 50 is the cost of buying one piece of bread, and we are doing at our break-even point, we are doing 10,000 pieces of bread. So how much will it cost us to buy the bread that we will sell for those 10,000 pieces?
500,000.
Thank you. I hope everybody gets that. So Ziwe, you're doing very well. Thank you so much, but I'm still with you. So our variable cost so far here is 500,000. Okay, so until there we've gotten sales of 700,000. We've gotten variable cost of 500,000, and then now remember, for us to get the break-even point, we earned a fixed cost of how much, Soziwe?
700,000. Fixed cost of 200,000.
Thank you. Our fixed cost was 200,000. So if you do sales 700,000, variable cost 500,000, and then fixed costs is 200,000. So you made sales of 700,000. It costs you 500,000 to buy, including other costs which are like rent, electricity, salaries of 200,000. How much profit did we make for that month?
No profit.
It is ideally we say zero, right? You know, when you say, so Zio, when you say no profit, it could also mean a loss. We did make a profit. So how much was profit in terms of a number? If you to put that as a number, 0. Thank you. Now, it's 0, right?
Yes.
So Zosiwe, you've been able to follow step by step with me, right?
Yes.
All right. So I am hoping everybody else has been able to see that. So you can see having calculated the break-even point, which was these fixed costs, where we dealt with 200,000 divided by the 20 shillings, which was the contribution margin for selling the bread. We've been able to find that now when you do your calculations of now where you do how much did you make in that period of time, the 10,000 that we got as the break-even point means when we sell 10,000 pieces of bread, we do not make any profits and neither do we make any loss. So it means the business is just at bare minimum. We've just been able to take care of all the business costs, business expenses, whether it is buying the item, the unit economic, that's unit that we deal with. You remember you said if it's like now in this case for this shop it was bread. If it is your patient, it is if it's a hospital, it's the patient. If it is like Simon does selling gas, your unit of economic is a gas, the cylinder, the gas cylinders together with whatever the way you buy it. So if every one of us, if you're able to do this, translating it to your business, you should be able to get what that break even looks like. So I hope that was something that you can be able to do. I know this is another example, you'll get it in the notes, but ideally it is the same thing, because here the example that we've given here, if everyone was to do it, is just your selling price, the same thing we've done, including the cost, and you're able to get how many units of that item that you deal with that you need to sell for you to come to where you're not making any profit, you're not making any loss. Now, why is this a very important number to have? The first thing is that it helps you to know at what point do you start making anything in the business. Now, remember, it is very possible. I go back again to recons. As long as you're keeping your recons well, this will not be very difficult. If you're not keeping recons, it will be a very difficult number to get, and you will never know whether all the money that is flying in your till, in your box, in your accounts, whatever it is that you're getting money, wherever you keep your business money, you'll never know whether you're making profit if you're not able even to know at what point you start making a profit. Now, if, for example, as a business owner, you know that I'm selling bread, I buy it at 50, sell it at 70, at least I need to do 10,000 pieces of bread for me to start making a profit. Definitely at the back of your mind, anytime you now sell 10,001 bread, now you're starting to make a profit. When you sell 9,999 pieces of bread, you're at a loss. I hope you're seeing that. So ideally, why you need this break even, it will help you in terms of being able now as a business owner to make decisions in terms of, like, even if you're pushing like your team, those people who have sales team, or even pushing yourself if you do the business by yourself, it helps you to know, as long as you've not sold 10,000 pieces, you're not in business. You're still making losses. Anytime you're selling anything over 10,000, then you're good to go. If this was like number of patients for the hospital, for example, assuming this was what came out for the hospital, you'd have been saying, as long as I don't see 10,000 patients, obviously I know that's a very big one for a hospital setup, but it's the same thing. If you're not making that much, then it immediately tells you that you need to work on something. So you either need to start thinking of what is it that you need to do to be able to make those profits. And so if it is so difficult to get 10,000, for example, per month, which is one period of time that is easy to measure. There are some people also who can measure their business weekly, even daily, and all that. You can do this with your systems in place. You can be able to see how much you're making per day, per week. But at least if you do it overall per month, it will have given you a very good idea of what is happening. Reason being, some days you may not sell enough to make profits. Other days you may be doing so well. So if you do it like in a period of 1 month, it's going to be able to give you a better picture of how your business is doing. So that is a very key number in terms of just helping you to be able to know whether you're in business or not, and what you need to do. So at times you find that decisions come in. For example, you realize making 10,000 is a hard call. So what do? Maybe we need to increase the price. Instead of selling at 70, we need to sell it at maybe 80 shillings. Because if you sell that 10,000 pieces of, maybe if you sell less, but for 80,000, you can be able to make more. So you play around with the numbers, especially for the guys who are in manufacturing, because it is your manufacturing that, I mean, the process, you know what, some things that you can do to reduce cost, so that the cost maybe of production is lower. Do you need to reduce the number of people working? Are there costs that you're incurring you shouldn't be incurring? So it helps you to start looking at what can you do to be able to ensure that you can have less number of units to get you to the break even, because the faster and with less units that you can get into the break even, the more profits you're likely to make. So I hope that is making sense. I know it's something that you do without even doing the numbers, but when you get this, it will also be able to help you see how now you can do it in a more formal and organized way. But I know at the back of your minds you still do it, and this also helps you not to just start seeing money as if when money comes, like you're making so much and probably you're really not making money. So this is very helpful for that. So I don't know how you feel about that. So Siwe, I was with you, so maybe just hearing again from you would be nice. How do you feel about just getting to know your break-even point? How would it be helpful for you to run your business?
I think it's one of the key important things to know whether you are making money or you are not making money. And I think it will also ignite or rejuvenate your spirit to continue when you realize that you are not, as much as you are not making profit, you are not making loss, so that you can plan better, so that you are able to make profit. It will help you to plan better to make profits.
Thank you. Yeah, thank you so much for that, Soziwe. That's a very key one. So actually, when it comes to making decisions, you'll be looking at how can I increase revenue. The more revenue you make, then it means you get to that break-even point faster. Or how can I reduce the cost? And this, takes again, and something that you're not doing today here, but it takes you now to your budgeting process. How now you can start knowing when you're doing your budgeting, how do you balance the things that needs to be done over the next period of time when you're doing your forecasting, your budgeting. It helps you to know how do you bring in the numbers that are going to start making value for your business. If you're doing expansion, for example, you do something similar to this for the new branch, as an example, you need to know now when I'm opening a new branch in a different place, at what point will that branch start making money? So you can be able to monitor, you can be able to do regular check-ins in terms of how the business is doing, in terms of those numbers, to be able to see how quickly are you getting towards making a profit. So you can almost sleep without even overthinking. Once you know this amount, 10,000 pieces of bread. So even if people are telling you in that new branch they're selling 7,000, it looks like it's a lot, but at the back of your mind, even though they are getting money, blah blah, all this, you've not started making money yet. Because for example, if you're doing expansion, probably the mother company is still taking care of some of the cost of the the new branch, like salaries and whatever, some of those things. But the moment you put it like a unit cost, it's a cost center. The new branch is a cost center on its own. You at the back of your mind, even when like you're using the main branch to support, at what point they'll tell you, when they tell you now to this month we sold 10 pieces of bread, now you can comfortably know now this branch is now next to being able to sustain itself. Otherwise, it's okay to be selling whatever they sell, and you can never know whether it's really making money or not if you're not doing something like this, and even your just current business. So I don't know whether there's any question to this. Let me see. Okay, there is no question. Please, anytime you need to ask something, feel free to type it so I can always come back and read. Or you can just spare the question for end of the session. You can always go back to the things you've done today. So I also want to leave that, and I hope you can see how that helps you to work your business through. So let me go now to the last one, which is the working capital management, which is also very key. Many times when you're going to to financiers, I know there's a lot of times you say, I want to buy some certain asset, or I want working capital for my business. So what exactly is working capital? And what are we talking when we say working capital? So many people, they just talk about working capital. Let me just hear what we normally mean when we are talking about working capital. Let me choose someone else. Daniel Kakuru. Daniel, are you there?
Yes, I am.
Ah, great. And don't worry whether you're right or wrong. Every one of us from day one, we said in adult learning, we are all right. When you say I need working capital, what do you normally mean?
Sorry, Master, just before we get into working capital, I'd actually asked a question.
Oh, sorry, I didn't see it. So sorry. Okay, go ahead. You can ask now that you're on whatever. Sorry, I didn't see the question. I went to the chat, I didn't see it. But go ahead and ask.
Yeah, so the question was, if you're dealing with multiple products, let's use the bakery example still. And you have bread, you have cakes, you have cookies, you have various products. How do you determine the break-even point for this? Do we have to do the calculation for each product line? And in this case, I imagine things like the fixed cost and the variable cost may have to be treated slightly differently for each of the different lines. Is that correct?
Yeah. Yeah, sure. One of the things we normally say when you're dealing with more than one, there are quite a number of businesses that are going to do more than one item. Remember when we were dealing with the BMC, I hope you were there during the time when you're dealing with the BMC, and we're saying when you're planning your business and you have different products, anytime you introduce a product, is like you plan for it on its own. Because remember, when you bring in a new product line, you need to know whether it is worthwhile having it or not. Even without doing these calculations, I am so sure those people who have dealt with more than one product, at times you've introduced a product and you're thinking, is it even making any difference? Is it making any difference in the business? And when you're asking yourself that question, you can only answer if you do this. So when it comes to fixed costs, what you need to do is there's something in accounting we normally call the name is disappearing, but let me paraphrase it. Something that makes sense, something sensible. I'm forgetting the accounting name that you use for that. But with your fixed cost, you can be able to apportion how much do you think is going into this kind, like if it's, for example, this kind of product, if you have many, that way you can be able to see if you're doing business properly. It's able to help you, because at times you can actually pick up those costs. If it is like, for example, rent, you can decide I'm going to do it on a straight line. I sell 5 products, I pay rent of 20,000. So for these 5 products, I'm going to divide it same for all of it. So of the 5 products, for rent, which is 20,000, it will be 20,000 divided by the 5 products. So rent for each product will be 4,000. If it is electricity, the same. So you can decide to actually, that is one of the easiest way. Just do it on a straight line. Divide whatever fixed costs are, divide by those number of products. Then now you can work for each of them and see what each of them is bringing. At what point what number of units of each products will you be able to sell to be able to take care of their portion of their fixed costs? I don't know if I've answered that, Daniel.
Sorry, I lost the last bit of it, but I understand.
Okay, sorry. I'm asking, have I been able to answer? Is it making sense?
Yes, just correct me if I'm wrong. So fixed costs will be spread across the different products, and then that's what utilized will be the calculation.
Yes. So you take the fixed costs. Like that's what I was saying. There are some products, I don't have them in mind, but I know at times when you're calculating for some products, you can almost be able to know how much you're using for them. But if you're not, just use the fixed cost, the total fixed cost divided by the number of products that you have. Then so for each of them, when you apportion that fixed cost, now you can be able to do the break even for each of the products. So you can always know that if it's a bakery, I can now see your question. It has bread, for example, for bread, we need this amount, this number of bread. we need so many cakes, we need so many cookies. Ideally, remember, this is just a number to help you to once making some decisions and being able to see where it is going. So if you have bread, cakes, cookies as the 3 product cost, have 200,000. Someone is asking something or is just talking. Maybe Natasha, you can mute them. So if you have 200,000, you apportion that 200,000 divided by the 3 products. So bread, cakes, and cookies. So for each of them now you can calculate the break even. So you realize that maybe over time you may realize that you're not getting the number of units for bread. Maybe it's not getting there, but cakes are selling so much. And that's how now you start asking yourself, like, what do I need even to keep more? It starts giving you ideas. Remember, numbers are only useful. They are best when they help you to make decisions. They help you to understand how your business is doing. So that's one of the ways you can do it. And the easiest way is just do a straight line division of the fixed cost with the number of products. Is that helpful?
Yeah, that's perfect.
All right. Okay, now I know for us to answer this question, and I hope everybody else is together with us. So I was just asking you, when you say you need working capital, what normally are you communicating? What are you saying? You're telling someone, hey, I need working capital to run my business. What do you normally mean by that?
I think it's the money you need to run your day-to-day operational expenses.
Okay. Day-to-day operations of the business. So when you say day-to-day, ideally, that's really very good. That's a very good answer. So again, because of interest, due to interest of time, I'll just go now to looking at that. What exactly we mean by working capital? Yes, it is what you need to do business on a day-to-day. And normally, when you're in a business, you're looking at what we call accounts receivables. I'm going to explain to each of them, inventory and accounts payable. So ideally what we mean, and when you're looking at the financial statements, I guess maybe in the next 2 weeks, you'll be looking at this to be able to derive what this exactly means. So if you're in the business of, let me use a product because it's easy. Again, we are selling bread. So what we mean by selling bread, it means when we sell bread, whatever we receive is what we call accounts receivable. So that's revenue. Whatever revenue we receive is what we'll be calling accounts receivable. Every time when you're producing bread and we have it in the shelves and all that in the trays, that bread that we have not yet sold, that's what we call inventory. And ideally, in other ones is stocks. How much stocks are you keeping? So maybe just making this easier is accounts receivable will be revenue. What revenue are you receiving? Inventories, how much stocks are you keeping? Then accounts payable is what do you owe other people? Normally, business owings will be normally like to suppliers, things that you've not paid. Like maybe you got some items, like I know there are people who run shops, and maybe the suppliers, they bring the flour, the sugar, the sausages and everything, assuming it's a shop, and are okay for you to pay maybe at the end of the month. So even though your shop is a stock, it's not yet paid for. So how do we determine now that working capital management? What we normally say is, because when you have accounts receivable, when you get money coming into your business, it's a positive in your business. It's a plus. Plus means it's money that you've received. And accounts receivable now, sorry, will be those which you have sold but you've not been paid. So it is you register it when you're doing profit and loss. You'll find that you register that as a revenue. You actually did sell, but you sold on credit. So if you sell on credit, it's money that has gone out, and it's gone out because instead of your customers paying you, you gave them your product, but they didn't pay because they'll pay at a later date. So when you have accounts receivable, maybe I can now talk to someone else so that I make this easier. Anybody dealing with let me talk to Simon. At least, Simon, I know what business you're in. Simon, are you able to speak?
Yes.
Okay, so I remember you're selling gas, right?
Yes, you're right.
Okay, so if you sell gas, let's say you sell 10 cylinders in a day, and each of them maybe you're selling for 1,000. I know it doesn't go for that. I want to make these maths very easy. So you're selling 10,000 cylinders of gas, and you sold 10 of them in a day, and only 4 people paid, but 6 did not pay. So how much cash did you receive for those 10 out of the 10 that you sold? How much did you receive? Each of them you're selling for 1,000.
So if it's only 4 who paid, that is 4,000.
Exactly. So you've received 4,000. How much is out there with people, because 6 of them didn't pay? So how much is out there?
6,000.
6,000. Thank you. Now that's what we'll be calling account receivable in the case of Simon, is the 6,000, because it's goods have gone out, not yet paid. So in other ones, you call them how much of debt is out there. So when you have not received the 6,000, is that a plus or a minus in your business finances?
Minus.
It's a minus. So it means you're lacking 6,000 in your business because someone has it out there, right? Thank you. Now, the other thing, when you buy the gas, because for someone to even know that you sell gas, you also have to display gas there. So you sell it, you buy it in time, you buy it in advance and display it there. So that means you spend money to buy, right? So
Yes,
assuming those 10, again, those 10, of those 10, you've only paid for 6, but you have not paid for, you've paid how much have you bought? For those 10 of them, how much did you pay? If you're buying each of them at 500.
Yeah, 10 of them, and then each is 500.
Yes.
That's fine.
5,000, isn't it? So you've already spent 5,000 to bring in stocks, right?
Yes.
So is that a plus or a minus in your business?
Because it's expenditure, it's a minus.
Thank you. It's a minus. So ideally, now, if what it means is that money is out there. So I just want to make this easier. I know these notes will be shared so that you can see how that comes. But the whole idea is anytime you're spending money, through anytime you allow debtors or into your business, they are carrying away your money. And in fact, for debtors, I normally say you always have to remember the moment you introduce credit terms in your business, those is what we call credit terms. Anytime you allow people to pay at a later date, those people are carrying your capital plus your profits. Please always remember that they're carrying with them that 6,000 you're talking about includes the profit that you were supposed to have made plus the amount that you used also to buy that gas, right? So you only see that what debtors mean in your business. They can actually make you close your business if you're not careful, and you lose including what you ever invested in the business. Anyway, also when you bought that now inventory, it means that there is stocks that you've bought into the business, and when you have paid for them, you've also paid for those stocks. Money has gone out. So imagine you're letting people go with money and you're also buying. So in essence, your 6,000 plus your 5,000 is out there. Is that so? Ideally, Simon, because you already spent 5,000 to buy, it's no longer in your pocket. It's no longer in the business pocket. And you've already allowed people to carry 6,000. If they never pay, you lose 6,000. So in essence, you have money out there. You have money out there that is sitting with people, or you've already spent of 11,000. Is that so, Simon?
Yes, it's so. Yeah.
So
my money is outside.
Yes, your money has not been paid or you have spent on buying, that is already money outside. So a whole total of 6,000, which was for accounts, the debtors, the receivables, and stocks that you've already bought for 5,000, all that has not been paid. As you've already spent this has not been paid. So in total, 11,006 plus the 5. So I hope up to there we are together. Now, let me explain the accounts payable. So the accounts payable is the opposite of the receivable. Here you let people on credit terms. You also can buy items on credit terms from your supplier. So what that means is you can be able to get to to your suppliers and they allow you a credit term. So anytime you buy from your suppliers and you don't pay them now, they've allowed you to sell the goods. So the goods are in your shop, but you're not yet paying them. You have not yet paid them. So that gives you a relief. Think of a shop like this. You're selling, say you have a shop where you sell just bread. So this is just a shop that sells bread, the one that we hand with the Zoziwe. So that bread shop, she buys bread from a certain bakery, and that bakery allows that they can bring the bread for her to sell. They'll only come for the money after 1 week. So that 1 week, she can be selling, but she has not really gotten any money out of the business. So that money is still in the business. So working capital, to be able to determine your working capital requirements, anytime your money is out there, if you nobody gives you any credit terms, if no one, like now the case of Simon, if nobody gives you credit terms, like you cannot go to your suppliers of gas and they only wish that you pay cash. It means if you allow people to carry away your money in terms of receivable, they carry the gas not paid and you're spending already. At this point, you need 11,000. However, if you were to get someone who can give you now the gas and maybe they allow, say, maybe even 4,000, not yet paid, they will collect at a later date. They relieve you because immediately you can be able to get goods which you need in your business, but they are not yet paid. So to be able to get your capital that you need, it's where you say 6,000 has gone out, plus I've spent out 5,000, that's 11, but I'm getting a relief from my suppliers who are not asking me for 4,000. So the amount of money that I'm actually lacking at this point to run business, because remember it's day to day, will be now 11,000 minus the 4,000, which is 7,000. So what you're really lacking is 7,000 in that period of time. That's how we calculate the working capital. Ideally, what that means, in simplicity, if you're for those people who have audited accounts, you just look at what are your current assets minus current liabilities. So when you go back, you can just look at that. It will also give you how much working capital that is. I don't want to get into the statements, into the financial statements, because I know you're going to be doing that. But remember, this is the accounts receivables, and the inventory. This will be in your current assets, and accounts payables will be the current liability. So when you minus the two, you get what is your what working capital you need. At any time, it means when you have spent money or people are owing you money, you need now to be able to see if you can match as much as possible, also be able to balance that with accounts payable so that you can be able to stay afloat, you can be on float. Now, I want to give an example like supermarkets. I think we've ever talked about this here before. Most of these big supermarkets, and I hope one of most, I don't know that there is any supplier of supermarkets here. Most big supermarkets, they'll give people, rather business people, what they call the shelf space, a shelf space. So if, for example, you produce whatever it is, peanut butter, or you sell bread or whatever, they'll give you a shelf space where you can display your items. And so because people will come buying and all that, so a lot of times supermarkets will not pay immediately. They will ask that you bring your stocks, you go and they will display them on the shelf, but they'll pay you maybe after like 60 days. So for them, they're having accounts payable period of 60 days. And now, because they sell everything on cash basis, they do not have any receivables. They don't have any debtors. When you go to the supermarket, you always have to pay immediately. And most of that inventory they have has not been spent on. Here and there, they may pay a little bit on inventories, but a lot of their stocks are just stocks from business people come and stock it and wait for pay to be paid. So most supermarkets, they actually operate on positive about all the time because they are selling without having to pay fast. I don't know that you can see that. So in business, we normally say if you can be able to get to a space like now where you get your accounts are payable immediately, so you sell on cash. You don't have people who are paying you at a later date. You don't have any credit terms, and your stocks, you keep lean stocks, like you don't overstock. At times say those are some of the issues we have, and that's what I would just want to discuss. I don't want to go to a lot of calculations. When you get this, you're going to be able to see the calculations of how you get what is the working capital management. But the simplicity of this is account receivable plus inventory less accounts payable. The less you have on this side, in terms of the less credit terms, the less stocks you keep, the more you have your money within the business, and the more accounts payable. In other words, you're not paying your suppliers in time. They allow you to trade with their products. You can pay at a later date. The better it is for your business. So for you to manage working capital, all you're doing now is, how do you ensure that you can reduce this side, increase this side? This is all we are saying. How do you reduce the debtors, reduce the stocks, or ensure that you're within what is manageable? And even how can you take advantage of what we call the trade terms with the supplier, so that you can have a higher amount that is sitting with you without you having to work on it to pay it immediately. So once you do that, the main thing that I would want us to look at, instead of me now going into calculations, we'll be able to get them. In the interest of time, you'll be able to get this. I know this takes a bit of time at times also to do, but just for you to be able to see what it is, these are all the things that I've talked about. And maybe we can just do one of them just to see how that works. We can just do one of them just to see how that will work. So like in this case, we are saying, like, suppose someone has inventories and the account terms are 30 days, and then they hold inventories for 90 days, and then they sell it to customers for 60 days. What is that cash conversion cycle? Is what I've been explaining. How many days do you stay without having money, and how much is that? So you look at the two amounts. How much is it and how many days? So if you have this, there's also a formula for calculating days. Again, maybe in this class you may not be able to do that, but maybe during coaching and all that, you can be able to see how you can calculate that, help you to calculate how many days are your debtors ideally staying out before they pay. You can have a credit terms of 30 days, but in 30 days, still people have not paid, so it increases. You can buy stocks, and maybe where you expect them to sell them in like a month, 30 days, unfortunately they were not bought, so they take maybe 40 days, 50 days. You can have maybe also your own, from suppliers, you expect them to have paid in maybe 40 days, but it took longer. So when you do the calculations, you'll be able to see how that goes. So it's how many days are you staying without money for that period of time. That's what now you're saying. Even when you go to a financier, they'll be trying to establish how much are you staying out of cash, and for how long, so that they can know they need to give you this. Even for yourself, if you know that, you can start being able to know, for maybe a period of 50 days, I don't have this much cash. How do I take care of this? Okay. So let me just do a calculation here. Just one, like now accounts receivable. Again, you'll get this so for formulas. So in this case, we are looking at revenue of, maybe you remember like the bread that we were selling. If you were selling those many, over a period of time, we've been able, maybe in a month's time, we were able to do 700 million. This is in Ugandan shillings. That's why the amount is so huge. So this is 700 million Ugandan shillings that you've been able to sell bread in that period of time of 700. Remember, whether you sell on credit or you sell on cash, you register your revenue in your sales record as sold. So it doesn't matter whether you've received or not, but at least you've sold 700,000. So normally there are 365 days in a year. So this is just a constant in all of them. Now we are saying it takes us 40 days. The business takes 40 days for us to be able to get back the debtors to pay. So if you were to look at how much now is out there, the formula is this again. We look at the total revenue, divide by the number of days. If you can be able to calculate that, anyone can use the phone. So your revenue is 700 million, divided by 365 or times 40 days. This is the number of days that you give your debtors to pay. So if someone was to do that now, can I ask, I don't know, anybody, before I give you the answer, so that you can just see, please use your calculator. I know online class, if you do online and you have to calculate, I hope you're not working as you're doing this. If you can just calculate for me this, I would really be grateful. So if you have 700 million over 365 days in the period, which is 1 year, times the 40 days, you're allowing your debtors to take 40 days before they pay you. How much will that be? Anybody? And then, okay, can I ask the guys, the men, please, the men, all of you, just calculate the one for the 700 days. I'll just get one of you to tell me. 700 million over 365 days times 40 days. And then the ladies, I want you to do the exact same thing, but reduce this number of days to 30 days. So total revenue is 700 million over 365 for the men times 30, for the ladies times 30. Please give me what you get. Make it a simple calculation on your phone. So can I ask Jojo? Jojo, have you calculated for the ladies? What did you get? Okay, I can see some answers from the men. Thank you, the men. I can see you have gotten 76, 712, 728. From the ladies, thank you so much, Christine. On behalf of the ladies, 57. So what that means now, when you look at this, assuming you sell exactly the same way, the man's shop, they sold exactly 700 million, and the ladies, you also sold 700 million the same way. The only difference was the number of days that were outstanding with the debtors. Now, when we look at the men, their answer was 76 something, 76 million or something. And the ladies, it is 57. So what does that mean? Let me now go back to the answers. This is what you got it right, Christine and Kina. The men, I saw your answers. So for the men who are doing at 40 days, you got 76 million 712 329. For the ladies who did the days of at 30 days, they got 57. Now, what does that mean? You can see just by reducing the number of days by 10. For the men, their shop was giving 40 days. The ladies were giving at 30 days. For just reducing the number of days, you're able to save yourself 76 million minus 57 million. So you're able to release 19 million. This is in Ugandan shillings, so I know it looks big amounts, but you can still follow. You're able you're able to save yourself 19 million 178,082 into the business by just reducing the number of days that are being owed by you. So in terms of your working capital, what that means, if you allow 40 days, you're going short by 76 million out of that 700 million. If you reduce by 30 days, you're going short by 57 out of the 700 million. However, so what does that mean? If you take to 50 days, this will be even higher. So that means you're almost going to 100 million in what your business is out there, the money that is out there. If you go like to 20 days, this will even maybe be something like 30 million, something like that. So that's what that means. And this now applies the same to the inventories. It applies the same to, it also applies the same to the stocks and also to the accounts payable. So we can also do this. The men, please work this now for inventory. You use the cost of goods sold, which is 350. And like I said, number of period in days in the period always remains 365. Always will remain 365 days in a year. And then the inventory days is 30. For the ladies, calculate with inventory days 20. What now on this one we're looking is how much does it take for us to, when we have the stocks we have, from the time we buy to the time we sell it, how long is it taking us to convert? So again, or rather to sell it all. So again, use this formula even when you're using for your when you're getting your account statement, it's the same. But ladies use 20, guys use 30. Let's see what answer you get. So you're using 350 million divided by 365 times 30 for the men and times 20 for the ladies. I'm waiting for the answer. None of them has written. You can use your phones, those who don't have calculators. Okay, so for the ladies, I can see for the ladies you've got a 19,178,000, and then for the men, I'm waiting for your answer at the number of days there were how many? Yeah, for the men it was 30 days. So for the ladies they're getting 19, and then for the men, any answer yet? I can see my time is up, but give me just a few minutes. It's exactly 12, but just give me maybe like another 10 minutes, I finish for you. Okay. Before you go into the filling the form, please give me an answer. Man, did you get anything? I don't know that they're still calculating, but in the interest of time, let's look at what they have. So for inventory, or rather for stocks, we have stocks which are worth 350 million in the business. So both ladies and men have the same level of stocks in the business. But because of how long, so those people have fast moving goods, like now the ladies have fast moving these, at least within 20 days, they're able to sell. They're able, within how much they're holding, that is not, that maybe because of how fast it is. Because if you're selling without holding at all, it means you'd have gotten your total 350 is what the value of stocks would all have gone out. But just because you're not able to sell everything immediately, it takes about some days for you to sell. So if it takes about 20 days, at least it's only 19 million that is held up. But if it takes 30 days, you hold 28 million. So the longer it takes to stay with the stocks, the more your money is in there. This is just showing you how you calculate, but I know even as entrepreneurs, you understand, the more stocks you keep holding, the longer you keep holding stocks, some of them get to be dead stocks, some of them, they get outdated and all that. The more you keep them, the more you lose. But the faster you sell, the better. If you sell by cash only, the value of all your stocks will be recovered immediately. But since that's not possible, you're only looking at how can you be able to reduce this. Now you see, by just reducing 10 days of holding stock, you release 9.5 million in terms of what is coming into the business by just reducing the number of days. So the faster you're able to sell, how that helps you, like with your salespeople, the more they can sell quickly, the more the goods are going out quickly, the more you can be able to have more money coming into the business. If you go beyond 30 days, the more you're holding more out there, the more your business suffers because of lack of working capital in terms of the stocks. So the last one, let's do the last one in terms of the accounts payable, and it's the same thing, the formula again, because accounts payable, now these are suppliers. So for suppliers, let's say you bought from them the goods which were 350 million, but it takes you 30 days. That means if you were to pay them immediately, you would pay them 350 million, because that's the cost of the goods, the much that they've sold to you. But because they've allowed you 30 days, what does that mean? How much does it relieve you? We are looking for how much relief you'll get in those days. Now, again, you can calculate for the men in 30 days. For the ladies, what if you were to increase that period by 40 days? What does that mean? So I don't know whether I will wait for us to do that because of time. Let me just show you the numbers, because at least you've gotten how it is done. So you can see for the same amount that you bought for the stocks that you bought for 350 million, but the suppliers allowed you 30 days. So the much that you're able to save yourself because of the 30 days they've given you. Remember, these stocks may not be sold, all of it, in 30 days. So even though by the time they're coming back for their money, you may not have sold all the stock. So when they come after the 30 days, because of that relief they gave you of 30 days, at least you are able to relieve yourself of 28 million. But now you need to pay the balance, because after 30 days you need to pay all of it anyway. And the more you increase, the more time it takes. You see, like when you go for 40 days, it will be 38 million. So the longer you take with the supplier's money, the more relief you get into your business. So ideally, again, the same thing, that if you able to negotiate with your suppliers further, and they give you another like 10 days more, instead of them coming for the money at the end of the month, which is 30 days, they allow you 40 days. You can see now you'll increase from 28 to 38. So it will be a relief of 38 million. And the longer it takes, the more you make in your business. So once you have that, so the whole idea is just looking for how do we manage that working capital. And the whole idea is how do you reduce the debtors, reduce the stocks, and increase the payables, because that is the way the business runs. You'll always have people who are not paying in time, except if you're like a supermarket which will pay in cash, then they don't struggle. So they have all the money, and any business that sells on cash, you don't struggle on that. Immediately you give a credit. What do you need to do? And those are some of the things now we start saying, how do you manage like the debtors? For example, you need to ensure that you can maybe like at times give discounts. I know many people struggle with debtors. The debtors book continues growing, and the more your debts are out there, we normally say the longer it takes to pay, the more likely that those debts are going to be bad accounts or bad debts. So what do you do to reduce bad debts? First is I normally say this: the moment you allow debtors in your books, please immediately have someone, a dedicated resource that is working on who is owing you what, so that they can do follow-ups. So if they're supposed to pay within 30 days, you start reminding them from the 25th day. If they go to the 31st day, you start having ways of ensuring that you're reminding them you can be able to get money back, because if it stays out there, it's affecting your working capital. So ensure that you invoice in time. You at times even give some structuring of, especially those who are staying with your debts maybe for longer. Maybe you can give them discounts so that they can, or maybe just structure how they can pay, and make sure that you, as much as possible, you're doing collections. Collections is very, very key. Create a department, create personnel who are going to do it, whatever it is, but monitor how much is out there. So when it comes to debtors, those are some of the things you can do. Collect as quickly as possible. Then with stocks, always avoid overstocking. Like, at times you buy too much stock, so don't overstock. So just purchase what is necessary, calculate how much stocks you need like per month, and just get that, because the more you buy, the more it stays in there. Understand what kind of goods you're dealing with. Some goods get outdated so quickly, like the people dealing with phones, and other electronics. You might buy something now, and in the next 2, 3, 4 months, if you bought so much, already that technology has passed you, so it becomes outdated. So just know how much you need. So do also stock audits, like where you do cut, that there are people who don't do stock counts, like stock taking. That's what we normally call it. Do stock taking to know how much stocks you're holding, and where possible, try to get systems that will help you to hold as little as possible, but you cannot miss the stocks. You see, like people who are doing drop shipping, they don't hold any stocks, but they sell on behalf of other people. So for them, stock issues, it's a non-issue, because they don't spend anything on stocks. They wait for them to find a customer who needs to buy some certain item. They quickly go to the person who has that, who is the supplier, get it and take it to the customer. So if you can be able to get almost what we call just-in-time kind of systems, you get stocks only when you need them, the better for you. But remember, this doesn't really happen in business. Most businesses will not be able to get that. So the whole idea is see how you can reduce dead stocks and just overstocking your place, so that you just hold what is necessary. That way, a lot of your money is not tied in stocks. And then also maybe something else you can do is where you when you're doing your stock audits, as quickly as possible, try and sell those items that have become dead stock or outdated. See how you can easily sell them, even if it's at discount or at cost value, just to, even if you don't make a profit. And then on the payables with your suppliers, try to negotiate longer terms, like we've said. Just increasing 10 more days, you can see the difference it's making. So negotiate. I think we dealt with negotiation somewhere when we were doing marketing. Try and negotiate with your suppliers to get longer payment terms, and even to stagger your payments, so that also you get some relief. And so that also when you're prioritizing your payments, as much as possible, just make sure you're monitoring your cash reserves. Like how much cash do you have. When you're doing again the financial statements, you're going to be dealing with cash flow statement and cash flow projections that will be able to help you to work on your cash reserves. But the whole idea is keep your records clean. I go back to where we started, whether it's personal finances, whether it is unit of economics, break even, or even doing this working capital, your record keeping needs to be so on point so that you can be able to know where you need to cut expenses, where you need to do better pricing mechanisms, where you need to work with maybe suppliers better. The whole idea is release as much money into your business as possible. Where you have gaps, now that's when you go now into investors to be able to help you to make those where maybe you have excesses. And again, one other thing you can try do is other than reducing waste and costs is also budgeting. Make sure that before you start the period that you're working in, you budget. This is what I need for my business. This is what I am spending. So you monitor regularly how you're doing it through your proper record keeping, and then you look for any variances, like you wanted to spend this but things happened, so there was a variance, you spent more, or you didn't spend all of it. So as you look at how your budgets are going, what you planned to spend vis-a-vis what you are actually doing, as you do those reconciliations to your budgets, and including even to your accounts, like the bank statement and pesa and all that, as you do your reconciliations, you'll be able to see what are the areas that you need to work on, what are the things that you need to do to be able to work on this. Do you need to automate processes? Do you need to, for example, if you're finding invoices are not being given on time, or collections are not being done on time, nor reminders on time, can you automate that process? Can you hire people to make sure, like I said, especially on debtors, make sure you have someone who is following on that? And then just that separating even the finances also is just very, very key. And yeah, so I hope that helps a bit. There are many things that you can do, but the whole idea is on working capital. Always try to ensure that as much as possible, you're bringing back money into the business. So I don't know whether there are any questions on the chat. I think I've already talked about this and so much more. Try to do credit sales, have a credit function, have a credit policy which will guide you on how you offer your services and all that. So yeah, so I wish to come to an end at this point. Are there any questions? I've taken a bit of your time past, and I'm sorry that we're already 12 minutes past. I asked for 10, but if you wish to have any question, please let me know how I can. Are you good? Christine, can we say we are okay, or is there any?
On my side, I am good, and thank you very much. This was informative. I think if I get the notes, I'll go through it again.
Okay. Is there any space that even at the top of your mind, we started with personal finances, we've done the break even, and we've done working capital. Is there anything top of your mind you feel like this is something I would want to work on? You just an imagination from your business. Anything that came quickly into your mind?
Yes, separating personal finances from the business finances, despite how small the amounts are.
Mm-hmm.
Yeah.
Okay.
Personally, Mercy, I'm so grateful for the session.
Okay.
But I wanted to find out when you're calculating the break-even point.
Mm-hmm.
For example, if I'm constructing some classrooms, maybe for bakery class, because when you give the example of bakery, that's exactly what I'm doing.
Mm-hmm.
So if I've been conducting bakery under maybe a small structure, but now I'm putting up a bigger structure to accommodate the bakery class and all the equipment and tools. So now I'm computing I'm trying to work on the break-even point. What can I do? Can I also include those expenses on construction, or I just look at the tools and equipment which are in the current structure and can try to work on the break-even point?
Okay,
Like
I get. Yeah, that's a very good question, Christine. Now there's something again that maybe we haven't covered here. I'm sure we'll be covering when we're dealing with financial statements. There's what we call, I know maybe in your business language you've had people talking about capex. What they normally mean is capital expenditure. So, like for example, if you're buying vehicles, if you're doing construction, like the way you're doing construction of a new bakery, that's capital expenditure. It's dealt with a little differently, which you may not bring in here because there is what we call the return on assets. We need now to calculate what we call return on assets. That helps you to know the asset because when you construct a bakery, that's an asset to the business. It will be able to help you know whether that asset that you've built, is it bringing back something. So when you're dealing with the ratios, that is somewhere we can be able to show you how now the assets, how you'll be able to determine how assets are bringing back funding into the money. But for these ones, we normally deal with operational expenses. That helps you a lot because it helps you to look at day to day, what are you dealing with? So it's operational expenses mostly. So capital expenditure like construction is handled in a different way. Yeah. So when you're dealing with the financial statement, the ratios, there's one ratio that I would want you not to forget so that you can see how it comes in. It's called return on assets. Please note it somewhere. When you're dealing with the ratios, you'll be able to see how the return on asset as a ratio helps you to calculate that. Thank you so much, Christine.
You're welcome.
Yes, maybe any other comment, any other question, or we can call it a day.
I think it has really been quite informative and enriching.
All right, thank you. Thank you so much for the feedback. And once you get this, please, I know this is just 2 hours. It takes time. Even for us accountants, it takes time for us to do all these things. So don't feel like if maybe you get confused somewhere, feel free to ask questions. We can be able to help you and guide you based on what kind of business you're doing. Thank you so much for your time today. I take it back to TBN.
Thank you so much, Mercy. Thank you so much, entrepreneurs. This is the start. We still have 3 more sessions to go in the Financial Mastery series. Next week, we will be looking at financial analysis of the financial statements. Partly what Mercy has spoken about while explaining the question that Christine gave. So we invite you back next week on a Friday from 10 a.m. to 12. That is East African time. And the ones logging in from Namibia and South Africa, that is 9 a.m. your time, 9 a.m. to